Assalamualaikum, my name is Alia Binti Raffi'ai. My group members are Nisa Nurina, Ayer, Fatini and Syafiqah Irdina. We are from BIA 4D. So today we would like to present to you about legal advisor service. So I'd like to present to you about introduction, classification of companies and types of companies. Companies in Malaysia are those entities incorporated under the Companies Act 2016 or under previous Act, Companies Act 1966. In contrast, a company has a broader definition to include any entity formed or incorporated or existing in Malaysia or outside Malaysia. A foreign company, a Malaysia or foreign partnership limited liability. However, it does not include any unincorporated public authorities or for commercial, sole proprietorship, cooperative and trade union purposes. There are three classifications of companies in Companies Act 2016. The first one is company limited by share. Second is company limited by guarantee. Is unlimited company. Company limited by share. It is formed on the principle that the liability of its member is limited by the memorandum to the amount, if any, outstanding of the shares held by them. Most companies are companies limited by shares. The shareholders are not liable for the company's debt. The shareholders' personal assets cannot be taken by the company to settle its debt. Second, company limited by guarantee. A company formed the principle that the liability of its member is limited by the memorandum up to the amount of members each can pledge to contribute to the asset of the company if it is dissolved. It is required to use its profit or other income to promote its object and is unable to pay dividends to its member. Third, unlimited company. It is one formed on the principle that there is no limit imposed on the responsibility of its members. If the company expires and has insufficient asset to settle its debt, shareholders are required to contribute the company's asset to enable it to settle its debt. It is similar to sole proprietorship and unlimited partnership. There are 5 types of companies in Malaysia. The first is private companies, second is public companies, third is exempt private companies, fourth foreign companies, and the last one is government-linked companies. Private company, private limited company with shareholding is known as Syarikat Sendirian Berhad, SDNBHD. Liability is limited by shares. There is a restriction on transfer of shares. Private company is prohibited from making any invitation to the public to deposit money for the company. It is a good method for companies to get investment without the risk of personal wealth. Second is public company. Public limited company generally known as Berhad. It is similar to a private company except that its share can be offered to the public for a fixed period and other forms of subscription. The members in public company minimum of 2 shareholders and must have more than 15 members. The maximum numbers of shareholders is unlimited. These companies are usually the business model of choice for large business. Third is exempt private companies, where beneficial interests of shares in the company are not held directly or indirectly by any corporation. None of its shareholders are corporations. Its maximum numbers of shareholders is only 20 members. Exempt private companies do not need to submit their annual accounts to the Companies Commission of Malaysia, which is known as CCM for public information. It is not prohibited from making loans to directors under Section 133A of the Companies Act. Fourth is foreign company. It is a company, corporation, society, association, or other body incorporated outside Malaysia. It is an incorporated society, association, or other body which, under the law of its place of origin, may sue or be sued, or hold property in the name of the secretary or other official of the body or association duly appointed for that purpose and which does not have its head office or principal place of business in Malaysia. The last one is government-linked companies. What is government-linked companies? Government-linked companies is corporate entities in which the government owns some or all of the share capital. Government may hold a stake in the companies using a holding company. These companies can be private or public companies. GLCS could be former government agencies such as Pos Malaysia, Petronas, Maybank, and Malaysia Airline System.
Hi, my name is Nisa Nurina Binti Hasnol. So I'm going to share about the registration requirement based on Companies Commission of Malaysia or CCM. Particulars required to incorporate a company. Under Section 14, Subsection 1 of the Companies Act 2016, the applicant must complete information required as follows. First, the proposal name of the company. Second, the status of private or public company. Third, the proposed type of business. Fourth, the address of registered office. Fifth, the business address. Sixth, complete details of directors and promoters. And last one, declaration from the directors or promoters that he or she is not an undischarged bankrupt either in or outside Malaysia and has not been convicted of any offence whether in or outside Malaysia. I'm going to share about the financial reporting requirements based on the Companies Act 2016 and the Financial Reporting Act 1997. Okay, the Companies Act 2016 and the Financial Reporting Act 1997 are the two main statutes governing financial reporting by companies in Malaysia. All information on accounting records of the companies that should be kept, annual returns to be submitted to authorized, and other matters as to capital and borrowings are managed and regulated by the Companies Act 2016. There is two independent bodies of the Financial Reporting Act 1997, which is Financial Reporting Foundation (FRF) and the Malaysian Accounting Standard Board (MBSP). Okay. First, accounting and other records. Under Section 243 to 251 of Companies Act 2016, it has been stated that the Act requires financial statements to be prepared and presented in accordance with all approved financial reporting standards. Second, financial statements. The financial statements are prepared by the directors of every company. It should be prepared at an interval of not more than 15 months before the annual general meeting of the companies or before the financial reporting distributed to the members. It should be duly audited first. And the last one, director's report. It has been stated under Section 252 of the Companies Act 2016. The financial statement of the company should be attached with the director's report. It may also contain a business review that are important in financial report. Next, the element of annual report. The annual report is a compilation of the reports and financial statement required by law or otherwise to be sent to the shareholders 14 days before the annual general meeting. The annual report may be main document of financial statement and general information of the company for the various users, both internal and external, regarding the past and recent achievements and the future plans of the company. Besides the audited financial statements, the director's report and the auditor's report are also to be presented to the shareholders. The annual report may comprise the following. First, chairman statements. Second, corporate governance statement. Third, audit committee report. Fourth, statement of internal control. Fifth, social responsibility statement. And the last one is financial statement.
I'm Ayer Fatini. I'm going to present about legal requirements in Bursa Malaysia Securities Berhad. Point number 1. Listed company require additional disclosure based on the performance of the company. Point number 2. Preliminary statement of result within 6 months with the end of the financial year need to display by the company. Point number 3. An issue half-yearly reports performance within 3 months must following the end of the half year is a must.
I am Nurul Syafiqah Irdina Binti Yusof, and now I will explain to you about the advantages changes from partnership to company from business. So the first one is management. Company members are not its managers or directors or agents. For partnership, Partners are agents of the partnership and are generally entitled to manage the partnership firms. Then, contract. A member of a company can enter into a contract with the same company. While for partnership, a partner within a firm cannot enter into a contract with the same firm. Other than that, legal entity. A company is a separate legal entity. It is a separate entity from its members, directors, promoters, and etc. Partnership firm is not a separate legal entity from partners. The partners of the firm are collectively referred as a partnership firm. Besides, expansion potential, as there is no limit to the maximum numbers of shareholders in a public limited company, expansion of business is easy by issuing new shares and debentures. So the maximum numbers for partners is 20, except for professional firms where the number of members is unlimited. It will hard to expand business due to lack of members. So the last one is succession. In a company, the succession is perpetual. The change of membership or death of insolvency of the members does not affect its affairs and existence of company. In a partnership, if the partnership is entered for a fixed period, it can be dissolved by any partner and is automatically dissolved by the death or bankruptcy of a partner. So that's all about the advantages changes from partnership to a company from business. We move to the next point, which is disadvantages changes from partnership to company from business. So the first one is change of name. The name of the company cannot be changed easily, and a prior approval of central government is required to change the name. The name of the partnership firm can be changed easily by having a discussion between partners. So the second one is registration procedure. The registration of company with registrar of companies is mandatory. The registration of a partnership firm is not mandatory. So the next one is dissolution. In a company, legal procedures are required for winding up the company for going ahead with liquidation. In a partnership, the firm can be dissolved with the consent of the partners. Next, changes in capital. To change the authorized capital of company took a lot of time and undergo through legal process. In partnership, the partners can easily change the amount of capital and no legal work required. And the last one is statutory regulation. Company right from its inception, it has to comply with various statutory regulation. In a partnership, thought governed by the Partnership Act is relatively free from statutory regulation. So, that's all about disadvantages and advantages changes from partnership to company from business.
Now, I'm going to differentiate the element disclosure in financial statement between company business and partnership business or sole traders. Point number 1, in company got shareholders fund that is equal to share capital plus return earnings plus other revenue and capital reserves. While in partnership business or sole traders, the owner's equity has only one item, which is the owner equity account. Number 2, in company, a limited company is imposed tax as it is a separate legal entity. But while the partnership business or sole traders, tax on the income of the owner or the sole proprietor. Point number 3, the company need to follow proper accounting concepts, principles, rules, and other regulatory framework. While the partnership business or sole traders, they not subjected to any accounting standards or generally acceptable accounting practices, GAAP. The owner can decide whether the financial statements need to be prepared or not, and if they decided to prepare, the form of the financial statements is also the decision of the owner. Point number 4, the company needs to audit it and therefore needs to follow a strict accounting concepts, principles, rules, and other regulatory framework. While the partnership business or sole traders, they do not subjected to audit the financial statement. Number 4, in the rent charges in company
company directors establish themselves a license. Doing so allows the director to charge a proportional amount of tax and interest, while the partnership business or sole traders cannot charge themselves rent for business use of a home. In general expenses in company, their personal expenses by considered earnings if incurred with directors and distribution incurred with shareholders. While the business partnership, also traders, the private use items include things like telephone, utilities, and vehicle operation. Thank you.
So the conclusion is, chapter introduction provides legal review aspect of company formation and company financial reporting responsibilities. Here's some of the link that we use for our reference to complete this presentation. That's all from us. Thank you.